Hello and welcome to the Week in Markets. I'm joined by Matt Henderson, Portfolio Manager, and today we're going to really focus on bond market volatility, what's been happening in the UK this week, and finishing off with the US. I suppose in financial services we often talk a lot about the equity markets, but if you think global bond markets, it's actually bigger in size, so they are important, and it's been a difficult start to in terms of global bond markets so far this year. We've seen notable increases in yields from UK gilts, but also US Treasuries. UK gilts, if you think about where the yields have got to, up to 4.9%, that's higher than what we saw in the period under Liz Truss when she was Prime Minister, and we saw back then that when yields pushed aggressively higher, it actually cost her job. So bond markets do matter. I suppose, Matt, if we think about why some of the reasons why we have seen some volatility within the bond markets, what would you point to, perhaps starting for the UK?
Yeah, so I think a theme that we have seen that's impacted bond markets is just market participants are focusing more on government spending. Yeah. And we've seen that not only here in the UK with the latest budget announcement from the Labour government, we've also seen that from the US with Donald Trump coming into office soon. So we know that global governments are looking to spend more money. And how do they do that? Well, they turn to bond markets. So when they turn to the bond market, they have to issue more bonds, and that pushes yields higher for investors to look to buy those newer issuance of bonds.
I suppose the nuance for the UK, Rachel Reeves has changed the fiscal rules, but she's increasing taxes, negative for growth, but then looking to spend more on non-productive areas. So really, investors haven't been liking that, and that's causing some of the volatility, specifically for the UK. I suppose thinking about the UK data, we've seen quite a bit of data this week. Inflation, people have been a little bit nervous about, but also economic growth in terms of GDP and retail sales. How would you summarise what we've seen this week?
Yeah, so I guess both of them are a bit more positive for bond markets. If we start with the growth data that you talked about first, that's the retail sales and the GDP. GDP is still behind where we see growth in the US, so numbers came in at about 1% for the year-over-year growth in the UK. And why is that a positive actually for fixed income markets? Well, lower growth is normally attached to lower inflationary outcomes because there's less spending. So bond markets have been quite pleased with that. When we look at the inflation data as well, that's actually not crept up. So if we look at those core measures where we focus on there, where it's looking at the more stickier areas of inflation, so we take out things like food and energy prices where they can be a bit more volatile, we've seen that rate come down as well, which has been really supportive for gilt markets here in the UK.
Yeah, and I think the reaction that we've seen within the bond market has actually been really positive since that inflation data report. As you point to, the sticky services component is actually trended down, and the reaction in the bond market is just reflecting just how nervous bond investors have got, and the strong rebound that we've seen since Wednesday is just a reflection that actually, thank God, we're on a better trajectory.
Yeah.
Super. So if we think about just gilts in general, gilt yields were at 4.9%, they're now at 4.6%. Now, if we contrast that to where we were 3 years ago, yields were at 1.3%. So we're significantly higher, which actually means looking forward, the return opportunity is actually quite attractive. I suppose even if there's a little bit of nervousness still about the trend of inflation, fiscal deficits, your starting level just gives you that greater cushion, even if yields move higher, but still allow you to generate a positive return over 12 months' time.
Yeah, so the payments that we receive as bondholders and the coupon payments that we get, they can actually offset, as you're saying, if prices move lower and yields rise, that can actually offset that, given we've got that higher starting point. And I think what's also quite interesting that we've seen from the US perspective on this is as we've seen better growth outcomes come through, we've seen the amount of rate cuts that markets are expecting move back. So at the minute, we're about 1 rate cut expected for this year, which means that actually we've got a lot more priced in for markets where actually if we do see, inflation start to come down in the US or growth not be quite as robust, the market does have the ability to start to price in more rate cuts in the US. So to your point, the forward-looking return outcome that we could see from fixed income does look better than where we were a couple of years ago.
And just finishing off with the UK, the Bank of England is going to meet on I think it's the 6th of February, where they'll be deciding whether they will cut interest rates again. They cut interest rates by 0.5% last year. I suppose the retail sales data, the GDP data that we've seen this week is perhaps supportive of further cuts ahead.
Yeah, it should be, but I guess what the problem the Bank of England has is just trying to assess where that inflation outlook is going. So if what we've seen from the budget is higher wages, more spending on things like that. So markets view is that will be inflationary. So it's that balancing act of how do we support growth over here, but how do we also deal with potential inflationary threats that we could see come through in the UK.
Cool. Thank you. And I suppose if we just move back, thinking about the US, we talked about stronger growth environments. Federal Reserve only expecting around 1 interest rate cut of 0.25% this year. I suppose we have had an important data point of their latest inflation reading it was also on Wednesday, like the UK, and again, slightly better than initially thought.
Yeah, so readings did come in line with consensus, but I think it's a similar theme to what we talked about over here in the UK, where the market was maybe a little bit worried that actually we could see the rate of inflation start to increase from where we are. So actually the fact that it came in line with what markets had originally thought was a kind of a bit of relief. And also within those, similar to the UK, with those stickier elements within services, didn't actually see those tick higher. They came down ever so slightly. So, the themes and threads are still there for US inflation. So I think the market was a bit relieved, and off the back of that, we actually saw markets have a bit of a rally.
Yeah, and that's bond markets and equity markets. Yeah. Equities have been very strong in terms of, if you think about UK markets, European markets, all had a strong rally. In the areas within the US market, such as small cap, Dow Jones, we've seen stronger returns across the board, really, which is really encouraging for multi-asset portfolios, which over the last month, we've seen a little bit of volatility, not quite as strong as what we saw for the bulk of last year. So it's pleasing to see markets back on a firmer footing. And all eyes will be to Monday, where we have Donald Trump's inauguration, and we'll start to get more corporate earnings results starting to come through. Thank you, Matt, and thank you all for watching. Have a great weekend, and we'll see you on Monday.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.